I welcome you to the Q4FY18 earnings call for Zensar. We have with us Mr. Sandeep Kishore, Chief Executive Officer, Mr. Navneet Khandelwal, Chief Financial Officer, and other members of the leadership team. Just to note, the call will begin with a brief management discussion on the performance for the quarter, which will be followed by a Q&A session. I will now like to hand over the floor to Mr. Sandeep Kishore. Over to you, Mr. Kishore.
Yeah, hi. Thank you, Vishal. Hello and good afternoon, everyone. Thank you for joining the Q4 Fiscal 18 analyst call. On the call today, I have with me the Zensar management team, Ajay Bhandari, Head of Strategy and Corporate Development, Navneet Khandelwal, Zensar's Chief Financial Officer, Vivek Ranjan, Global Head of HR, and Sanjay Rava, our Global Financial Controller. As I always do, I will give you an overview of Q4 Fiscal 18 and follow it up with a commentary on the full financial year. This will then be followed up by an update on other financial matrices from Navneet, our CFO. After that, we will open the floor for questions. I trust all of you have had the chance to go through the detailed Q4 Fiscal 18 financial results and the fact sheet that we released yesterday. Let me take this opportunity to present some key pointers. Q4 kept up our sequential growth momentum. On an overall basis, we delivered revenue growth of 3.2% sequentially and 14.2% year-on-year, both on dollar terms. With this, we have grown 3+% sequentially in each of the 4 quarters of Fiscal 18. Our Q4 gross margin had a modest sequential growth of 0.7%, and EBITDA fell by 6% in US dollar terms, largely affected by an increase because of provision for a doubtful debt from one of our clients in the US. Despite this, both financial matrices saw significant YOY growth of 20.8% and 76.5% respectively. In Q4, our PAT grew sequentially by 23.8% and on a year-on-year basis by 632.6%. In fourth quarter, we won a $79 million TCV network managed services deal at the city of San Diego in the U.S., which is largest cloud infrastructure deal we have won to date. It will also serve as the lighthouse for the transformation of our cloud and infrastructure business going forward. Fourth quarter, our digital revenue accounted for 40.6% of the overall revenue, a growth of 8.2% sequentially and 34.6% year-on-year on account of our digital engineering capability, our proprietary Zensar Return on Digital platform, and foolproof. We crossed $50 million quarterly revenue in digital for the first time, and on a run rate basis, we are on a $200+ million annually. Foolproof grew at a commanding 25.9% sequentially and delivered the numbers on the strength of its major logo, along with customer transformation-related digital deals with the combined capabilities of Foolproof and Zensar, creating a strong pipeline for opportunities and bolstered front-end development work. Keystone, the company we had acquired in March 2017, continues to perform well. It grew 5.6% sequentially. The synergistic capabilities of Zensar and Keystone is generating a lot of interest and traction within our client base, and we see more businesses being booked for our combined capability sets, particularly in the retail and consumer market. We are very pleased with the performance of Foolproof and Keystone post-acquisition. Last quarter, we had also acquired the acquisition of Cynosure, a Guidewire implementation partner in PNC insurance space. The acquisition is now closed, and Cynosure is part of Zensar's team from second week of April onwards. Zensar's application services business delivered healthy growth this quarter. Application services, which includes digital, grew 4.7% quarter-on-quarter and 11.1% on constant currency basis on back of the strong digital revenue. Our overall infrastructure business declined 15.3% sequentially and 18.5% year-on-year on constant currency. With a new leadership team in place, revised service catalog, focused sales strategy driven by account mining, cloud and autonomics, we feel that FY19 will see a turnaround of this business. Our key market of US has continued its growth story by delivering 1.5% sequentially on a larger base on constant currency. We now have a solid and stable sales engine in place, and we have started seeing results in deal and new pipeline. The digital sales team has picked up significant momentum, both with existing as well as new clients, which will serve us well as we move into fiscal 19. Our Europe business did very well by growing at 3.2% sequentially and 24.4% year-on-year on constant currency. Africa also grew 12% year-on-year and had a marginal decline of 0.9% sequentially on constant currency. We are executing well on our strategy to expand our business with the identified top-tier clients. We are going to FY19 with a renewed focus on increasing business from our top clients considerably, as well as increase our wallet share. Our digital platforms and solutions are key pivots to expand our entrenched relationship with the top customers. We now have 17 clients in the $5+ million category, up from 13 over the last 12 months. Our top clients' revenue have been increasing steadily quarter on quarter. In quarter 4, our revenue from top 5, 10, and 20 clients grew sequentially at 10.1%, 9.9%, and 9.3% respectively. We continue our emphasis on digital, and our entire business strategy pivots on our digital capabilities and services. Zensar's Return on Digital, our proprietary solution that we launched in quarter 2 of fiscal 18, continues to gain acceptance from our clients, and we've closed several deals over the last 7 months. We had $2.5 million in revenue through Zensar's ROD sales in fiscal 18. We also closed $20+ million associated with ROD on the digital services business and directly influenced by ROD platform. Our other digital platforms like Zen Analytica are driving growth of analytics in our company. Several large digital and traditional deals that we have closed have Zen Analytica embedded in them and have helped us close those deals. Our robotics process automation business have seen increased traction, particularly with the financial services customers. We've also revamped Vinci, our cloud orchestration platform, through more autonomics-based service catalog. Most of our wins this quarter have been in the digital space. You can find all the details in our press release. During FY18, our utilization increased by 480 basis points from 79.6% to 84.4%. Our attrition dropped by 50 basis points from 15.4 to 14.9. At close of fiscal 18, our global headcount stood at 8,905, a net increase of approximately 400 Zensarians around the world. Zensar continues to be included across reports by reputed industry analysts for our capabilities. Some of the notable ones are Zensar was featured in the Gartner Magic Quadrant for Oracle Application Services Worldwide 2018. Zensar's Agile and DevOps services featured in Gartner Toolkit. Zensar's mentioned in Gartner Guide for Business Outcome-Driven Enterprise Architecture Consulting. Zensar's mentioned in Gartner Magic Quadrant for Managed Workplace Services. Zensar named in Everest Group Cloud Enablement Peak Matrix Report. I would also take this opportunity to speak to the changes that we have made in Zensar over the last 2 years. Most of you who have been tracking us closely would have seen these changes, but I would like to enumerate them for benefit of those who have recently started interacting with us. We have been steadily increasing our focus on core business. Other than MVS, which is part of our cloud infrastructure services, and ROW region, all businesses are part of core. Over the last 2 years, core business as a percentage of total revenue has steadily increased from 86.7 to 90.8% of revenue. The growth in our core business was at 9.6% against the company growth of 5.6 in US dollar terms in FY18. We will continue to focus on strengthening our core business. We have significantly stepped up our focus on digital, both organically as well as through acquisition. Digital now accounts for 42% of our core business and has been growing at a rate of over 35% year-on-year. This growth has been quite broad-based and encompasses all aspects of digital. We now have a CXO-facing ROD platforms, solutions and services for all of our key verticals, and are a large part of our growth are led by these services. We have our own platform for analytics, agile, customer and user experience, autonomics-based cloud and infrastructure management. We have significantly stepped up the positioning of Zensar in our customer ecosystem. Most of Zensar's platform solutions and services are now featured in the leading analyst research reports, as we mentioned earlier, such as Gartner, Everest, IDC, Forrester. Earlier this month, we were honored to feature at a new case study by Harvard Business School. Harvard Business School has written this case study on Zensar's leadership transition and its digital-led strategy. We've upgraded our people capability significantly by training all 8,900 Zensarians on digital, and most of them have been certified to up to 4 of the 5 levels of digital certification. Our focus on our key accounts has started paying off well. As I had mentioned earlier, we now have 17 accounts with $5+ million in annual revenue. This has been through a combination of dedicated account delivery and digital specialists for each account, and we've talked about this earlier in several of the analyst calls. We are also significantly upgrading now the digital and the infrastructure capabilities into these accounts. We have completed 3 acquisitions in the last 18 months of capabilities we felt were strategic for our company and would be a key aspect of driving future growth. Foolproof for customer experience and user experience and digital agency, Keystone for omni-channel and digital supply chain, and of course the most recent Cynosure for platform implementation in P&C insurance sector to drive digital enablement of their businesses. All 3 acquisitions are a significant part of our growth story going forward. You will also be pleased to know that Zensar has now filed 25 patents in the last 2 years. It was nil 2 years ago. Innovation is at the core of our investment into platforms. Zen Labs, which is the center of these innovations, is now also engaged with several of our clients in the areas such as blockchain, AR, VR, and MR, natural language processing, IoT, and artificial intelligence machine learning. We are currently building an AI-based recommendation platform which has applicability into both retail and insurance in driving personalization and microsegmentation, an AI-based horizontal conversational platform which has wide use in many B2B applications, augmented reality-based computer vision solutions that use a combination of AI and IoT to create smarter factories and retail stores. This has wide use also in the P&C insurance sector. Hyperledger-based blockchain solution for supply chain management in retail and manufacturing. Over the last 2 years, we've also significantly added to our leadership team around the world, across business units and functions. Navneet, our CFO, and Vivek, our CHRO, who are on the call with us today, have joined 3 and 6 months back respectively. Our leadership team in the U.S. also joined in the previous 2 to 6 quarters ago. We are very pleased with all of them settling in fast. I feel very good about our talent and capabilities that we are building in our company. So all in all, it has been an exciting 2 years. And with that, let me call Navneet, our CFO, to provide update on key finance data, post which we will open the floor for questions. Navneet?
Thank you, Sandeep. Good afternoon, everyone. Welcome to this call. In addition to Sandeep talking about the business, I will take you through key aspects of the financials. We have reported revenue for the quarter at rupees 8147 million, which reflects a sequential growth of 2.6% in rupee terms. In US dollar terms, the reported revenue is $126.6 million, which reflects a growth of 3.2% sequentially. Our annual revenue for financial year ended 31st March 2018 is rupees 31,077 million as against 30,556 million last financial year, which reflects growth of 1.7%. The US dollar average exchange rate during this quarter has been 64.34 per dollar as against 64.72 in the quarter before. And the year before in the same quarter, it was 67. The effective tax rate for the quarter is at 28.8% versus 33% in the previous quarter. This is primarily on account of reduction in the U.S. tax rates and increase in a proportion of exempt profits from the SEZ units in India. DSO as of 31st March 2018 stood at 67 days as against 66 days in the quarter 3. The total amount of outstanding hedges as of 31st March 2018 was equivalent to US dollars 85 million against 47 million in the previous quarter. With a view to increase in liquidity in our stock, the board of directors of the company have approved splitting of company's equity shares of rupees 10 into 5 equity shares of face value of rupees 2 each, subject to the approval of shareholders. The board has also recommended a final dividend of rupees 7 per share, taking the total dividend for the financial year ended 31st March 2018 to 120%. With this, I come to the end of my presentation and open the house for questions and answers.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1 on your telephone keypad. The first question is from the line of Mukul Garg from Haitong Securities. Please go ahead.
Thanks for the opportunity. Sandeep, first of all, good execution. Congratulations. On a couple of questions on on the quarter. First of all, in the presentation you mentioned a mega order which you have won. So, is it possible to share any details? Who is the client, which region or segment it is from, whether the order was digital, what is the duration and revenue impact of it?
Yeah, thank you, Mukul. Yes, we won quite a significant order from one of our topmost customers. We have not publicly declared the name of the customers, but it is from our top 5 clients. It is a combination of digital plus traditional. It's a significant one, and hence it's not just pure play digital. A lot of that, almost 90% of that, we've already started executing in, and the revenues are already in the quarter 4 of fiscal 18. It's a US-based client. It has a combination of analytics, campaign, data, and several of the asset, management. Not hand and field support, but managing assets from a software-led technology here. We had to also deploy a lot of subcontractors, for that particular contract because it has a lot of on-site based US component work.
Okay, so should we assume the profitability in this particular order to be a little bit lower than what we usually see at the company level?
It will be in the Zensar average. Like when the normal ramp-up happens, you will see marginally lower, which is very normal into executing programs like this. But as we get into steady state in 2 to 3 quarters, it should come back to the company average gross margin.
Got it. And second question was on South African market. It saw a bit of a dip this quarter. So how should we look at it going forward?
Sure. Ajay, you want to add?
Yeah, Mukul. So the South African, we just checked based on the question that you asked yesterday, we just checked it. But there's a very minor drop in just one of the clients. That's because there's a project ramp down. There is no change in any of our clients. The business in South Africa continues to look very good.
Understood. And the final question is on the non-core business lines. You have given a breakup. What are the options which are in front of you? How will you deal with it going forward? How should we look at it?
So all options are open. The reason we've called it out, and we have publicly been stating the MVS number and the ROW number for a while, and you are actually seeing the trend. It's not a business area which is a revenue growth and a focus area for us, and I've stated that for several quarters now. It's a profit improvement area. but it is non-core. So we are exploring all options at this time for those businesses.
Understood. Thanks for answering my queries. I will get back into the queue.
Sure. Thank you, Mukul. Thanks.
Thank you. The next question is from the line of Madhu Babu from Prabhudas Lilladher. Please go ahead.
So congrats on the strong turnaround in the performance. So first on the insurance, I think with this acquisition we tried to plug in or another vertical gap. I mean, I know that we have two good large accounts in insurance, but this acquisition will again further add new clients. So how do we see the insurance vertical from here in terms of scalability?
So, thank you, Madhu Babu. You've called it out quite correctly. Insurance as a sector, obviously we reported as part of our financial services number, which is roughly about 20%. 15% of that is actually insurance itself. And we are quite well entrenched in all the three core regions, US, UK, and in South Africa. Traditional services have been a part of our offering, which is traditional AMS, and of late over the last several quarters, we've of course been pushing a lot more digital. But we did not have the platform capability. And unless you have platform capability, such as Guidewire, you really are not going to be business critical for particularly the PNC category. So that was the business rationale. We've been looking to acquire a company for a couple of quarters, and we found a fantastic and great synergy in Cynosure. They are a Guidewire implementation partner. They are now roughly about 150 plus Guidewire consultants across US and in India. And they have a set of newer customers. Their market segment focus, however, is different than what Zensar traditionally does. So Zensar would go into Tier 1, which are large Fortune 500 PNC insurance. Whereas the standardization of operating platform, which Cynosure has been focusing, is largely in Tier 2, 3, and 4. Mostly Tier 2 and 3, which are between 1 billion to 2 billion or 3 billion kind of companies, annual license premium here. So we feel that there are great overlaps. We can take the Guidewire capability into core Zensar customers around the world, and we can take the digital as well as cloud capability and traditional AMS into the Tier 2 and 3 customers. So you should see expansion into our insurance market presence with the combined offering. Exactly the way we have done it with Keystone and Foolproof.
Second, sir, on the large deal win, I mean, it's a unique deal, I think, for an Indian IT vendor. So how is it the timeline for the ramp up, and would there be further this kind of deals which we will be able to win?
So
the San Diego, the government contract in US, that's what I was talking.
Yeah, sure, absolutely. So, we've announced two large deals in the last fiscal. One we publicly announced, the city of San Diego.
Yeah.
The other, we did not, but it is an equally large deal. And, we've talked about it earlier as well, that our focus is work with fewer customers, work deeper. And you're now starting to see results, particularly in the top 20 accounts, because we have put a very focused client, mining strategy, which has a unique combination of sales delivery and digital consulting. And with the infrastructure and cloud infrastructure services coming up, you will see that also baked into the top tier account. Large deal is the other focus also, and these are the first two deals that we fought and won. There are fewer large deals of this nature in the market. Most of the deals are between 10 to 25, 30, 40 million, $50+ million. There are not too many deals in the market. So you really have to work with the advisor network. We are in the market. We are still competing for a few large deals. And, we are pretty hopeful that some more wins will happen in fiscal 19 of $50+ million.
Yeah, but this particular deal, it's complete on-site execution, right? So how was the competition? Were there any Taiwan IT vendors? And, the scope of work also, if you can explain on the San Diego deal. Thanks.
Oh, sure. Yes. So San Diego deal, the nature of the deal is it's a government client, and you would have to execute it from the U.S. We are executing it, and I've stated this earlier, with 45 local U.S.-based resources between San Diego and Dallas. We have we are currently in the transition phase. We will get into steady state in about 4-5 months. It's a long, and yes, we competed with a global tier 1, not with an Indian tier 1 in this case.
Okay. Sir, if I ask one more question, just now that I think digital has become 40% of revenues and we have a good competency on the front-end user interface transformation, etc., can we pitch into newer verticals like travel or even other verticals where there's, a digital capability, you can go through with that capability and go to newer verticals?
It's tempting, but no, it's not a part of our strategy. I think our strategy is focused on the existing market segment because we still think there's enough room for us to grow into retail consumer, which is now 30% of our market, financial services, largely insurance 20%, and in manufacturing. So no, I don't think at this time we are looking at adding any new vertical.
Okay, thanks, sir.
Sure.
Thank you. A reminder to the participants, to ask a question, please press star, then 1. The next question is from the line of Prakash Chelam from Marathon Edge. Please go ahead.
Hi. Couple of questions. If I were to look at your organic growth, FY18 over FY17, by taking out the impact of both Keystone and Foolproof for each of the 2 years, could you comment on whether that growth would have been positive in the core business? Because on the reported numbers, it looks a little flattish. That is one question. And the second, I noticed that there's a significant increase in your G&A expenditure by about $7 million to $49 million. Could you just give us some color on that? Thank you.
Yeah, sure, Prakash. So I will give some commentary and Ajay can add as well. The organic business, if you take Foolproof and Keystone out, actually Foolproof was already a part of our numbers in fiscal 17 as well, although part of the number. Keystone came in all into FY18 only. The core business, particularly in the top 20 account, actually has done quite well. So of the top 20, which has been a part of our focused growth strategy in any case, and the number that I called out in my earlier commentary, of the top 20 between Foolproof and Keystone, I would think there are probably 5 or 6. The other, 14 or 15 are traditional core Zensar accounts. So that's done quite well. What has declined, and hence you're not seeing the number in the organic, is actually our infrastructure business. So infrastructure business, if we do the math, I think has a decline of about $14 million year on year between 17 and 18. And hence the overall numbers on a pure organic basis looks the way it is currently. On SG&A side, the reason for that spike, as we had mentioned earlier, we have taken a write-down based on provision for one of our key retail customer in the U.S., which is going through, Chapter 7 currently. There are still some buying discussions out there for them, but we have taken a decision to write down large part of that. Some part of it will still go into first quarter of fiscal 19 as well. Ajay, you want to add anything more?
Yeah, I think Prakash, your question on G&A was for the year as well. And in the year, I think the two are not strictly comparable simply because there's the full impact of Keystone G&A as well as Foolproof's more than 7 months G&A in it. But there's, apart from the provision for doubtful debt that Sandeep just mentioned, there's nothing extraordinary otherwise. I mean, it's just the regular G&A there.
So your SG&A at about 17% is something which you expect of revenues is broadly the number. Used to be around 15%.
Yeah, so that's, you can take that as the new normal for us.
Okay, all right. Just one last question. I think your free cash flow conversion, do you see that going down, increasing? Because, even if I exclude the M&A portion, it seems to have dropped year on year. The free cash flow from operations after CAPEX, excluding the amount that you're spending on acquisitions. Could you just comment on that?
Navneet?
Yeah, Prakash. So, as you will see, our DSO has increased from last year to this year, and part of it is due to as a result of the acquisitions coming in with a slightly higher DSO. Also, there are certain wins in this year where there has been an adverse DSO impact, and hence the cash generation has gone down. We expect this to be in the similar range in the coming year, and as these deals get into more of steady state, we will see a systemic improvement on this.
And my last question, sorry, is that the cash and cash equivalents which you currently show on your balance sheet do not factor in any payment that you have made for Cynosure yet. Is that right? And you might also have a contingent payment still linked to your earlier acquisitions. So any payments for Cynosure or any performance-linked earnouts for your previous acquisitions are not factored in right now into that cash and at this point. Is that correct?
Yeah, you are right, because as of 31st March 2018, the closing of Cynosure acquisition had not happened. So that cash does not factor in the payout, which is a subsequent payout.
Okay. So can we roughly factor in about 30-odd million for Cynosure and about 10-odd million for the earn-out payments from the previous acquisitions? Is that something we can broadly order of magnitude use to look at cash reductions?
Yeah, you can model on those lines.
Okay, great. Thank you. I'll have a few more questions, but I'll come back at the end of the queue later.
Sure.
Thank you. Participants, to ask a question, please press star, then 1. The next question is from the line of Sagar Lele from Motilal Oswal. Please go ahead.
Hi, thanks for the opportunity. Sandeep, you've plugged a lot of gaps in modernized offerings in both retail and financial services. But in manufacturing, what's your current go-to-market like? Are you kind of happy with that? What plans do you have for improving the mix there? The vertical's not really done much over the last 5 years, so any immediate steps that you would probably like to highlight?
Can you just tell us again who asked the question?
It's Sagar from Motilal Oswal.
Yeah. Can you repeat the question again, please?
Yeah, so I was saying you've plugged a lot of gaps through acquisitions and modernized offerings in both retail and financial services. But what's your go-to-market like at the moment in the vertical of manufacturing? And what steps do you think you should take to improve the growth trajectory there?
Yeah, so this has, to a certain extent, been a conscious thing we've done, in the sense, we regard manufacturing as a slightly slow growth vertical. So for us to, beat, say, an ASCOM, average growth rate for the industry, any such, we needed verticals which also were large spenders, which is why we had to correct the portfolio of services for retail, and we've done that for insurance as well. Now, and one of the reasons for doing that is we also felt that manufacturing was always, in a way, complete, because we had a strong ERP offering. We now have a strong cloud offering as well, both in Oracle as well as in SAP. We have a strong infrastructure practice, and typically in manufacturing, most of the spend happens in these 3 areas. We have, 2 other capabilities for manufacturing which we are now using to penetrate manufacturing. First is we have a pretty strong now IoT story, especially for smart factories. And we also have a strong B2B commerce story, because roughly if you take our e-commerce revenue, roughly 50% of them is B2B commerce. So we believe that, this is complete. If you look at manufacturing for the last 4 quarters, I think barring the first quarter, there has been a steady growth in that quarter as well. So you'll see the revenues from manufacturing also getting back into a lot more positive growth going forwards.
Got it. And secondly, on the IMS bit, the services portion is something that's obviously not non-core. But I remember you talking about some license revenue there that needs to be pruned out. And that's still not grown in FY18. Growth, if I look at over the last year, has still been about 5%. So any highlights on or any plans that you'd like to probably share on that particular piece?
So there are 2 components to that. I think Sandeep already answered the question on leadership. So we now have a new leader for that business. He's revamped both his team as well as the strategy for that business. I think we should give it a couple of more quarters before, you can see some very positive movement in that business. But coming specifically to your question on license revenues, which is basically what we used to call products. So the products business, which used to be much higher, is now at a run rate of around between 10 to 15 million. We don't track it or show it separately anymore because we don't have a separate sales team anymore with that sells products, but still it's incidental to our services business. And we are at the moment tracking between 10 and 15 million in that business. There is no current strategy to significantly increase that business. We think it will basically remain in the neighborhood of 10 to 15. Our pure play services business, though, actually has shown increase quarter on quarter this year. So it has grown each quarter. It's still, I think it can do a lot more, and we are waiting for Harjot and his team to revive that business. But as far as products is concerned, it's going to remain flattish or somewhere in between 10 and 15 million next year.
How much would have the services business, the pure play services business, have grown in FY18 over the last year?
So it's around 40 million now, around 40 to 45 million roughly, and it would have grown around I think year on year around 6 to 7%.
Great. Sure. Thanks a lot, Ajay.
Thank you. A reminder to the participants, to ask a question, please press star, then 1. The next question is from the line of Vishal Desai from Axis Capital Limited. Please go ahead.
Yeah, hi. Just quickly to get a sense on the demand environment that we are foreseeing going into FY19, could you outlay to us in terms of what has been the deal pipeline overall, and which are the areas where we are seeing traction and what kind of services that we are offering? That's part one of my question.
So, Vishal, I think the demand pipeline is quite good in our core market, which is South Africa, US, and UK. Also, that's the key reason on why we have started now focusing even more on the core sectors and the core market. What we are seeing quite clearly are the deals which are in the range, and there are several deals which are in the range of 10 to 30, $35 million. And there are a few which are north of $50 million across the businesses, financial services, retail, and I would call out high-tech more into manufacturing than the broader manufacturing. The capability Ajay was talking earlier about from a manufacturing point, there is a good potential for us to leverage the digital supply chain capability of Keystone, which currently is tailored more towards retail and consumer, to also be aligned into the high-tech, because the digital supply chain efficiencies are equally relevant there, and we're working on adopting to it. I think what's doing quite well for us, and that's the reason you're seeing significant traction and growth, particularly in the top 20 account, is a digital-led win. So the return on digital framework, there are 30 different platforms that we have built in. Our clear focus is to have that into every single opportunity, because that's the uniqueness of our company. And wherever we are putting that in, I think the conversion rate is quite high. We also started selling this as a platform. I mentioned to you earlier, we sold about $2.5 million worth of platform revenue. I mean, it's small compared to the overall size, but it's a big shift and a big change that we are driving. And it also drives additional revenue and businesses on the digital services, digital engineering, digital services as well. So I think my commentary on the overall demand environment across these three markets is actually quite good right now.
Sure, that was helpful. Just to get one data point in, we've earlier highlighted in our earlier earnings call around 700 to 800 million being the pipeline. Any kind of up move in that, given that the overall demand environment has been improving from what we've been hearing from other peers?
So, for our size, I think we are still, and we should remember that when we mentioned 700, 800 at that time, it included two of the deals that we consummated and won, and currently in the execute phase. For now, we are still in that range of $700, $750 million of pipeline as on date.
Sure. And secondly, just to get a little heads up in terms of the overall impact that one could, while you not quantified it, any chance that we can get some sense in terms of what could be the headwind on this in Q1 due to the client-specific issue in retail?
It's difficult to quantify for the single reason, and this client is quite well known. We don't, of course, name it out here because they're still not settled the Chapter 7, and there are still some buyers out there for this particular client. So we have taken a good portion of that as our hit. We've talked about it in Q4. There is, I think, in the range of probably $1.5 million or so still remaining, which we will take a call, whether to take it in Q1. Ideally, we'll probably take all of it in Q1 and be done with it.
Sure. So if Q1, it's supposed to be around 1.5, how much was it in Q4? Maybe I missed the number earlier.
We haven't called that out, but it was in the same range.
Sure. Yeah. Okay, perfect. And just one last thing from me. Just to get a sense in terms of FY19, we have exited FY18 at EBITDA margins of around 11.7. Could you tell us what could be, a key driver or a boost in terms of the margin levers going into FY19?
So we are not really, guiding anything, Vishal, but, if you've seen as a management, we've tried our best to show positive EBITDA growth quarter on quarter. And if you take barring the fourth quarter where we had to do a unplanned kind of provision, the growth has been, pretty consistent. I mean, it's been consistently going up. We are taking all efforts to improve all margin dividends, gross margin, have a better leverage of our SG&A. So, the endeavor of the management is to take the EBITDA over the current levels, though we are not guiding any number at the moment.
Sure. But in terms of lever, would it be fair to assume that utilization is pretty much maxed out, given that earlier you all had commented that 83 is what we would typically want to function at?
Yeah, I mean, utilization, which was at 83.8%, yes. I mean, there is not too much room there. Mm-hmm. But yes, I mean, the growth will be the biggest lever, I think, for improving your margins.
Sure. And one final one, just on the IMS piece of it, could you break out in terms of what could be the trajectory going in FY19? Not necessarily some color in terms of what to expect in terms of momentum out there?
I think, it's fair to assume it will do far better in FY19 than what we have done in FY18. We are still probably 2 quarters away, our Jyot and team, and we are completely redoing that entire go-to-market team because that was an area of big focus for us. We have not done well in the cloud infrastructure in the last 12 to 18, 24 months. So there's a huge market, particularly in our existing customers. And we tested it out. We competed, with the best out there for the city of San Diego, and, we won. So we feel pretty good that the new service catalog that we have built, which is largely around, public cloud and autonomics, which has AI and automation, built in, and cybersecurity. There's pretty significant, demand out there. So early days to say the growth trajectory for cloud and infrastructure business, give it about 2 quarters, and we're tracking it quite closely. But it will do much better in 19 than 18.
Perfect. Thanks, gentlemen. All the best for FY19.
Sure. Thank you.
Thank you. The next question is from the line of Madhu Babu from Prabhudas Lilladher. Please go ahead.
Sir, the payout for Synergy has been around $28 million as per the schedule which you have shown. So we have paid fixed of $31 million and the earnout is around 28. So if I'm right, are the targets very aggressive? Because if I take the total amount, it is almost coming to $60 million, which will be almost 3 times the sales for the company.
So Madhu, it's a business that has the potential to grow pretty rapidly. And the targets are in line with that potential. So, yes, I mean, so they do have a good growth target, and if they do achieve it, yes, they will be paid the earnouts. But the earnouts are paid only if they meet their numbers. So it's highly number dependent.
Okay. So and the other one on the IMS, as of now, if you see this quarter revenue, almost $18 million. So of that, how much is the non-core MVS and rest of the world combined? And after, the new management would try to revive it, or would we look at exiting this after 1 year from now?
No, so MVS business we've already called out, Madhu, that it is non-core. Harjot and team are not focused on MVS. They are focused on growing core cloud and infrastructure business. We are certainly looking at doing some more profit improvement in the MVS, and as I mentioned, we are exploring all options on that business.
So Madhu, if your question was what does MVS plus ROW in terms of revenue contribute? Roughly $10 million.
Of the 18 million, 10 million is from both of these. Okay. Okay, sir. Thanks a lot.
Yeah.
Thank you. The next question is from the line of Ashish Chopra from Motilal Oswal. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sandeep, just one question. It was to, get your sense on the progress in terms of the returns on the restructuring exercise within the U.S. as to, where do we stand currently. So we've seen some good early indicators in terms of some of these larger deals that seem to be coming along. But if you could just throw some light on, the U.S., excluding the impact of these defocused areas such as MVS, and also excluding the impact from the acquisitions like Zensar next year, as to how do you see this go along?
Yeah, sure, Ashish. So, U.S. has two components. One is the cloud infrastructure, and the other is the application and digital businesses. The application and digital businesses are then further broken down into verticals and, some client-specific business unit. All the business heads in the U.S. have now been with us for, as I said earlier, between 2 to 6 quarters. Some businesses where the heads have been there for 4 or 5 quarters or 6 quarters have actually settled down, and that's where you are seeing some of the large wins, which we have announced. So other than infrastructure services business, I think the application and digital, manufacturing, retail, financial services, those teams are settled down. There are deals in the pipeline, and it's a journey. But I think we are pretty much at the last phase of the leadership and the sales team there. More or less, all the people are in. So we've got to start fighting and winning.
Got it. That's helpful. That's it from my side. All the best.
Thank you.
Thank you. Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference over to Mr. Vishal Desai from Axis Capital Limited for closing comments.
Thank you everyone for joining this call. On behalf of Axis Capital, I thank the management team of Zensar for giving us this opportunity to host the call. I would now like to hand it over to Mr. Kishore for the final remarks, please.
Yeah, thank you, Vishal. Thank you, everyone, for participating. There were some excellent questions. And again, looking forward to talking to all of you in our next quarterly earnings call. Thank you very much.
Thank you very much, sir.